Welcome back to Talk Tickers, the show where we take a deep dive into earnings calls and try to figure out what's really going on.
Yeah, get past the headlines and all that.
Exactly. And today we've got a really interesting one for you. Honeywell, big company, everybody knows them.
Right.
They just had their Q4 2024 earnings call.
Yep.
And, there's a bit of a twist.
Yeah, a little bit more than a twist, I'd say.
Oh, okay, yeah, you're right. They absolutely crushed their earnings, beat expectations. Everything looked great.
And then, boom, they're splitting up.
3 different companies.
3.
It's a lot to unpack.
It really is.
So where do we even begin?
Well, let's start with, the good news, right? I mean, they had a phenomenal Q4.
Right. Organic sales growth was up.
Mm-hmm.
Adjusted earnings were up.
Yeah. Exceeded their own guidance, which is always a good sign.
Definitely. So what were the big drivers there?
Well, aerospace, as usual, was a star performer.
They've been on a roll, haven't they?
Yeah, double-digit organic sales growth again. Strong demand in both commercial, aftermarket, and defense. Mm-hmm. And they actually, they called out specifically, investment in electrification as a key focus going forward. So they're really thinking about the future there.
That's interesting. So they're seeing growth now, but also investing for the future, which is, I guess, what you want to see.
Exactly. Now, building technologies, that segment also did very well.
Driven by
strong project backlog, lots of new construction, especially data centers, airports, even hospitality saw a bounce back.
So they're benefiting from a bunch of different trends there.
Yeah, pretty diverse mix of projects, which is good for stability.
Makes sense. Now, what about industrial automation? That was the one segment that didn't seem to do as well, right?
Yeah, there was a bit of a little bit of softness there, especially in those short cycle products.
Short cycle.
Yeah, the stuff that gets ordered and shipped quickly. Demand for those is still kind of, muted.
So maybe a sign that the broader economy isn't quite as strong as some of the other indicators might suggest.
Should be worth keeping an eye on for sure.
Okay, so overall, a strong Q4, some potential headwinds on the horizon.
Right.
But then the split.
The big news.
Yeah, I mean, they're splitting into 3 completely separate publicly traded companies. Honeywell Automation, Honeywell Aerospace.
And Advanced Materials.
Right, which I guess was already in the works to be spun off, right?
Yep, but now it's part of this bigger restructuring.
So what's the thinking here? Why split up a company that, on the surface seems to be doing pretty well?
Well, that's the million-dollar question, isn't it? Welcome back to Talk Tickers. So we left off with a bit of a cliffhanger, right? Honeywell, after a great Q4, announces they're splitting into 3 different companies.
Yeah, it's a head-scratcher. You'd think a company doing well would, stick together to keep the momentum going.
Right. But Honeywell's argument is that each of these segments, they're calling them strategic business units, they each have different needs, different opportunities.
Different challenges too, probably.
Absolutely. And they believe that by separating, each unit can be more agile, more focused.
Okay, so let's break it down segment by segment and see if that argument holds water.
Sounds good. So, first up, Honeywell Aerospace.
The one that's been really killing it lately.
Yep, and they're really leaning into that momentum, especially when it comes to electrification. Did you see that they mentioned developing their own battery technology?
For aircraft.
Specifically for aircraft, they're talking about, urban air mobility, electric planes, that whole space.
Wow, that's a big bet. I mean, that technology is still kind of,
early days.
Yeah, exactly.
But Honeywell clearly sees it as the future, and by spinning off aerospace, they can, really pour resources into that R&D, those partnerships.
Makes sense. So less red tape, I guess, if they're on their own.
Exactly. Now let's move on to Honeywell Automation. They're really focused on digital transformation, leveraging data, AI, all that.
Yeah, the Honeywell Forge platform, right?
That's their big play. They want to be the go-to solution for industrial companies looking to optimize their operations, improve efficiency.
It sounds a bit like, what Google's trying to do with Nest, but for factories instead of homes.
That's a good analogy. It's about taking all that data, all that connectivity, and using it to make smarter decisions.
Interesting. But also, a little bit scary.
Mm-hmm.
All that automation, all those robots. What happens to the human workers?
That's a valid concern, and it's something Honeywell will have to address. They argue that, automation can also create new jobs, higher skilled jobs.
We'll see. But for now, it seems like they're betting big on the robots taking over.
At least in the industrial space, yeah. Okay, last but not least, we have advanced materials.
This is the one that's been a little bit quieter, right?
Yeah, they're kind of, under the radar compared to the other two, but they're doing some really interesting things, especially in sustainability.
Like what?
Well, they're developing new refrigerants, ones that are much more environmentally friendly than the old HFCs.
So good for the planet.
Exactly. And they're also working on, specialty materials for electronics, batteries, even healthcare. So they're kind of tapping into a lot of those, mega trends that everyone's talking about.
Okay, so it sounds like each of these spin-offs has a story to tell, a reason for existing.
Yeah, they're not just, random pieces of the old Honeywell being thrown together. They each have a clear focus, a clear strategy.
But does that mean they'll be successful? I mean, are there any risks to this whole split thing?
Oh, absolutely. There are a lot of things that could go wrong, and that's what we'll dive into next.
Welcome back to Talk Tickers. So we've gone through the what and the why of Honeywell's big split, but now the question is, what happens next?
Right. I mean, it's all well and good to have a plan, a strategy, but can they actually pull it off?
Exactly. And what should investors be watching for, to see if this is really going to work?
Well, I think execution is key. I mean, this is a massive undertaking, splitting up a company like Honeywell. There are going to be a lot of moving parts, a lot of potential for things to go wrong.
So you're saying it's not a slam dunk?
Definitely not. I mean, think about it. They have to separate their operations, their finances, their IT systems, and they have to do it without disrupting their business, without losing customers.
Yeah, that's a tall order.
Yeah.
So if I'm an investor, what are some red flags I should be looking for?
Well, any signs of delays, cost overruns, things like that. If the separation process starts to drag on or if it starts to get really expensive, that could be a problem.
Okay, so keep an eye on the nuts and bolts of the split. Make sure it's going smoothly.
Exactly. Now, beyond that, you also want to look at, how each of these new companies is performing financially.
Right, because ultimately that's what matters.
Absolutely. Are they hitting their revenue targets? Are their margins improving? Are they generating cash flow? Those are the things that will tell you if this split is actually creating value.
And how about leadership? I mean, each of these spinoffs will need its own management team, its own culture.
Right. And that's something else investors should pay attention to. Who are the people leading these new companies? What's their track record? And are they able to attract and retain top talent? Because at the end of the day, it's the people who make or break a company.
So it's a lot more than just, drawing lines on a piece of paper and dividing up assets.
Oh, much more. It's about people, it's about strategy, it's about execution.
A lot of potential, but also a lot of risk.
That's the nature of any big corporate move.
All right, well, we've covered a lot of ground today, but before we go, I can't resist. It's time for our outrageous but plausible trade idea. Remember, this is not financial advice, just a little food for thought.
All right, lay it on me.
What if, and this is where it gets a little crazy, what if this whole breakup trend, this idea that smaller is always better, what if it's wrong?
Interesting. You're saying maybe conglomerates aren't so bad after all.
Exactly. What if investors start to realize that there's value in diversification, in having a portfolio of businesses that can offset each other's risks?
So you're thinking a contrarian play, bet against the breakups.
Maybe. It's a long shot, but hey, sometimes the craziest ideas are the ones that pay off.
Well, that's certainly something to think about. Thanks for the deep dive.
And thank you for joining us on Talk Tickers. We'll be back soon with another earnings call teardown. Until then, happy investing, and remember, always do your own research.